Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about Aritzia stock. I will discuss their business, their future plans for 2022, the risk associated with this company, and finally I will provide a detailed stock analysis using my personal discounted cash flow model, and will then provide you the fair value of this stock depending on your investment goals. The company HQ is located at Vancouver, British Columbia, and their shares are traded on TSX for almost 58 Canadian dollar at the time of recording this video. They don't pay a dividend, and the market cap of the company is around 6.4 billion Canadian dollar. An interesting fact about Aritzia stock is that they beat S&P 500 for the last 1 year and even for the last 5 years in terms of the returns, which is amazing for a Canadian company, and it shows the potential of this interesting business which can provide you with amazing capital growth in the long term. Some people tend to compare Aritzia stock to Lululemon, to early days of Lululemon, and say this is the best Canadian growth company to buy right now. And some people believe Aritzia's stock price will crash significantly and should not touch it at these crazy PE ratios. In this video, we will find out what you should do about Aritzia stock. Before starting the video, I want to emphasize that I'm not a financial advisor. This video is not a financial advice for you to buy, hold, or sell this stock. This is just my personal opinion, and you should always do your own research before making any financial decision. With that being said, let's start the video. Aritzia is a vertically integrated Canadian company which design, produce, and sell clothing and accessories mainly for women. I should mention that they just started to expand into men clothing too, which I will discuss further in the next parts of the video. They sell pretty much everything related to women clothing and accessories, including sweatshirts, leggings, pants, dresses, jackets, sport bras, hats, bags, shoes, belts, and even iPhone cases. The company operates approximately 100 boutiques, and they offer products under various brands including Wilfred and TNA. They call their products everyday luxury, which means they consider the products' price tags to be somehow affordable compared to super luxury brands, which, to be honest, I don't exactly find these prices anywhere close to affordable. But my opinion is not important at all, as I'm not really into fashion and things like that. But my wife actually loved their products, and she continued to buy Aritzia products every single month. I know many other young girls and women who spend thousands of dollars shopping at Aritzia website or stores, and overall it seems that they know their customers pretty well. If you ever walked into an Aritzia store, you immediately get what I mean by knowing their customers. Aritzia is looking to grow their business in 4 main categories, which are e-commerce or online presence, store expansion, product expansion, and also brand awareness, which means using celebrities to promote their products. They anticipate to continue to grow their business exponentially and are looking to open 7 to 8 new stores and expand 6 stores in 2022. Just look at these numbers and compare the expected revenue versus capital expenditures in 2022, which is absolutely amazing. They have a great website with very attractive and simple design, which even has a live chat option, which is very handy for customers. And they plan to continue to increase their online presence and online sales in 2022 and beyond. They also recently bought a men's sport clothing designer and manufacturer to enter into men's clothing business, which can be a new income stream for Aritzia in the coming years. Aritzia was able to outperform S&P 500 in the last 5 years, and it was mainly due to their insane business and earning growth in the same period. Before COVID, they were able to grow their revenue by an average of 16% year over year, and their earnings before tax and deductions by almost 19%, while maintaining a very healthy margin. Just look at the e-commerce sector, which actually grew significantly in the past couple of years and now is a comparable source of income to their physical sales in the stores. The earnings reduced due to COVID like any other retailer, which is normal, but they actually had an amazing last few quarters and were able to grow these numbers significantly. If we look quarter over quarter, we can see that they were not only able to grow their revenue and earnings, but also they were able to grow their cash flow significantly in the past quarter, which caused a 20% jump in Aritzia's stock price after their recent earning report. As a final point, I want to mention that Aritzia sales in US is more than doubled in just under a year. Now just imagine if Aritzia increased the number of their stores in US and imagine how much they can increase these numbers. Aritzia does not pay a dividend and therefore we don't have anything to talk about here. Aritzia debt to equity is around 0.86, which is fine, and their cash flow is relatively large to cover their liabilities in the long term. They slowly increase their profit margin too, which is nice for the business. So it seems in terms of the business itself, they are doing fine. But clothing and fashion is a tricky business, is a tricky sector, and while the trend can be your friend in the short term, it can be actually your biggest enemy in the long term, as we cannot predict trends in fashion industry like the other businesses. I'm also not sure if entering into men's clothing is a wise decision for Aritzia, as it is highly competitive field and their stores are not really designed for men because it's more feminine. So they had to do some changes in that regard too. Nevertheless, the most important risk for Aritzia stock is not the business itself, and it is the valuation of the stock. Price to earning, price to book, price to cash flow are all traded at much higher multiples compared to even average 5-year of the same company and even to the index. There is definitely hype in these valuations, and that is where you should be really careful about buying Aritzia stock at such high multiples. This is my favorite part of the video where I can show you my stock analysis based on the financial data I discussed in the previous parts of the video. I use a discounted cash flow model, which basically estimates values of stock based on projections of their future cash flows. So I make some assumptions about the growth of the company in the next 10 years and then discount the future cash flows into the present value of the stock based on my expected rate of return. So I start with the past 4-quarter free cash flow of the company, and based on 3 different scenarios, I predict the future cash flow per share of the company in the next 10 years. In the bear case, or the most negative case for the stock, the company can grow by 10% in the short term, and then the growth rate will drop to 5% in the long term. I consider terminal multiple to price to cash flow of 8 for this case, which is consistent with historical bear periods for these type of businesses. This is the case that Aritzia fails significantly in the coming quarters, and as it is not that probable outcome, I will give this scenario a 25% chance. For normal case, I consider a little bit better growth and a terminal multiple of 11, which is historical average of a fashion business. I assign a 50% chance to this scenario. For the bull case, or the best possible outcome, I consider the business grows by 30% in the short term, and then it drops to 16% in the long term. And I considered a terminal multiple of 18, which is the bull multiple for fashion industry in the long term. I assign a 25% chance to this scenario as well. For growth stocks, I usually expect 15% return year over year, and for dividend stable stocks, I expect 10% return. So if I expect a 15% return year over year from this stock, the fair value of this company is 48 Canadian dollar, which means compared to current share price of almost 58 Canadian dollar, the shares are traded at almost 17% premium today, which is not a buy according to the model. It means if you expect 15% return on your money year over year, this stock is probably not going to deliver that 15% return in the next 10 years. If I put 12% as my expected return, you will see that the current stock price is at 8% discount for a 12% return. It means you can probably expect the company to return close to 12% year over year at the current share price, which can be a good return. It's always fun to see what analyst predictions are for the company, and according to Yahoo Finance, the analyst price target for this company is currently at 64.86 Canadian dollar per share for 2022 with a strong buy rating. Aritzia is a fast-growing business with excellent potential, and they know their customers pretty well. According to the discounted cash flow model, it seems like it can return close to 12% year over year in the next 10 years at the current stock price. if things goes smoothly for the company. Personally, I don't hold Aritzia in my own portfolio, but my wife has a large position in Aritzia. And we started to buy the shares for her when it was traded around 28 Canadian dollar. I would personally not buy Aritzia at these valuations anymore, as it probably cannot provide 15% return year over year, and it's a risky business for me. But if you're happy with 10 to 12% return year over year, and if you don't mind a bit of downside risk, it can still be a buy. I hope you enjoyed the video, and if you enjoyed the video, please leave a comment and let me know what stock you'd like me to review next. And please consider subscribing to the channel to see similar videos. Thank you for watching, and I see you in the next video. Farewell.